Ladies and gentlemen, welcome to the second day of the ESG conference on banks, institutional investors, and firms. The conference is co-organized by the Institute of Finance and Financial Regulation and EBRD. Yesterday, we had a very fascinating day, which we hope that it has proven to be very stimulating. Today, we're going to have an equally stimulating day. And without further delay, we're going to start by opening remarks from Professor Christos Saikouras, who is Minister of Finance of the Hellenic Republic. What it may not be well known for Mr. Saikouras is that he's also an associate professor at the Athens University of Economics and Business. He holds a PhD from Bayes Business School, formerly CAS, and an MSc from Imperial College. And he's also a very prolific researcher with more than 50 articles. So Dr. Saikouras combines both the academic profile as well as the professional profile that IFFR is after. So without further delay, Professor Saikouras, the floor, or the screen, I should say, is yours.
Thank you, George. Thank you for the invitation. I'm happy and honored to participate in the opening of the second day of the Institution of Finance and Financial Regulation's interesting event. An event focusing on the advances and challenges of ESG for banks, firms, and institutional investors. As we all know, ESG standards were first mentioned 16 years ago as the core of United Nations principles for sustainable investment. Today, ESG are widely acknowledged as a valued instrument, not only for policymakers, but also for investors and firms that seek to advance their sustainability goals while gaining added value and competitive advantage. Ladies and gentlemen, the European Green Deal, the European Union's common growth strategy based on a new sustainability paradigm, is a roadmap which comes with a keyword. And this keyword is investment. According to the European Commission, in order to achieve the 2030 climate target, the additional annual investment should, on average, reach 360 billion euros. It is therefore necessary, especially in today's challenging landscape, to focus on promoting policies and tools that will foster sustainable investment and support banks, firms, and investors towards transitioning timely and efficiently to this new sustainability model. In this context, the Greek Minister of Finance has been systematically promoting a number of significant reforms. First of all, in 2020, a new omnibus law set a new, improved legislative framework that modernized corporate governance in Greece while enhancing corporate responsibility, transparency, and sustainability. Second, in cooperation with the European Commission and EBRD, we're in the process of designing a comprehensive capital market strategy, as well as a sustainable finance strategy, both based on particular needs of the Greek economy and its capital market. Third, in the context of designing and implementing our sustainable finance roadmap, a dedicated working group has been set up by the Ministry of Finance, including the Central Bank of Greece, the Greek Capital Markets Commission, the Hellenic Bank Association, and other key stakeholders of the private and public sector. Fourth, we are seeking to adopt tax policies advancing the redirection of resources towards financing the green transition. Fifth, Greece is actively interested in exploring the option of issuing green bonds with a debut deal which could be incorporated in the Hellenic Republic's funding strategy of the second semester of the year, according to the circumstances. And finally, last but not least, we have been gradually implementing, since early 2020, a green budgeting framework in order to advance our climate targets through public economic governance while achieving fiscal sustainability. The 2021 state budget was the first to include explicit references to climate circumstances and considerations. Ladies and gentlemen, the sustainable finance landscape surely presents a set of significant opportunities as well as challenges. Meanwhile, the pairing of the climate emergency with a global pandemic and most recently the energy crisis has created an environment of long-lasting increased uncertainty. In this context, it is my firm belief that both public policies and the financial system hold a determining role, a role that can and must play in order to successfully promote sustainability and resilience of our economies and our societies. Thank you, George.
Thank you, Professor Staikouras. Thank you, Christo, for your time and for your valuable comments. I think we can move on now to our next speaker, who is Dr. Haris Labropoulos. Dr. Labropoulos is president of the Hellenic Development Bank of Investments. He is also an assistant professor at the University of Patras. Haris has a quite rich professional experience as well as an academic career, and he's holding a PhD in economics from the London School of Economics. So Harry, welcome to our conference. Thank you very much for joining, and the screen is yours.
Thank you very much, Professor Skiadopoulos, dear George. Let me share the screen with my presentation. It is a great honor to be part of today's conference, and I want to congratulate the Institute of Finance and Financial Research Regulation and the team of Professor Skiadopoulos and EBRD for organizing this exciting event. I was participating in yesterday's session, and it is indeed very exciting. From my part, I will speak on how venture capitals take ESG into account in the case of Greece. So let me start by saying what is Hellenic Development Bank of Investment is. It is the sovereign fund of funds of Greece. Our main activity is to manage state and EU funds. And the purpose is to procure and invest these resources along with other investors in new venture capital and private equity funds, mainly on a pari passu and money-in approach. Since the establishment of HDBI as Taneo in 2000, it helped kickstart the VC market in Greece, and today we are steadily working towards the enlargement of the equity ecosystem in Greece, fostering international best market practices. Our investment programs are across multiple sectors and asset classes, focusing in supporting innovation and entrepreneurial landscape, and the target is to produce positive impact in the Greek economy. Currently, the funds under management we have been mandated amount to 2.1 billion euros, and they expect to have significant multipliers of 3.5 to 5 times, while we are the equity platform instrument of the National Recovery and Resilience Plan known as Greece 2.0 of our country, as well as to manage on behalf of the state the resources for Festos Fund for 5G. The epicenter of our strategy is the further development and strengthening of the Greek venture capital ecosystem. That's why our mottos are summarized in "We invest for growth, for financing innovation." This reflects actually to our core vision and embedded values. In doing so, we have a lot of solid partnerships and synergies that we have developed during the years. And on the European level, we are working very closely with BPI France, while we participate in the landmark EU initiative, Scale Up Europe, to accelerate European tech. We are founding members together with BPI France, KfW Capital, TESI, and Versfonden to manage, in the first place, 3.3 billion euro of equity investments. Also, we are working closely with EIF, the European Investment Fund, and soon we will announce some new initiatives in key sectors. On the international level, we also have strong partnerships with major international sovereign investment institutions. Our main target is to attract investments in our country and co-investments for our fund managers and companies. The existing agreements that we have are with Mubadala Capital and Abu Dhabi Developmental Holding Company, ADQ. They were recently announced officially during the Prime Minister's visit to Abu Dhabi, and they worth 4.4 billion of potential inflow, capital inflow to the Greek economy. Also, we are in close collaboration with Bahrain Sovereign Wealth Fund, Mumtalakat, and we are in discussions with the Public Investment Fund of Saudi Arabia. Our vision is to HDBI to be the credible equity sovereign partner of Greece to facilitate successful investments, to act, in other words, as an ambassador and further catalyst to support the Greek venture capital and private equity ecosystem, and thus bring small and medium enterprises and startups in the epicenter. This is to accelerate sustainable growth by paying attention to the market needs, by fully incorporating international best practices, and by mobilizing all types of resources, financial or other. And coming to the core of this event, to abide with ESG criteria, and also with the recently introduced by the Resilience and Recovery Facility funding, the do no significant harm principles, which means to have social and environmental impact and serve the sustainability strategy towards sustainable finance. Our central ESG philosophy is that ESG criteria are neither a panacea nor an unnecessary bureaucracy. To the contrary, they are a competitive advantage. They should not be a distinct part of an organization strategy, but they have to be a fundamental component of its DNA to emerge across all of its activities, either internal or external, to be the character of the organization and not his external appearance. Always during the existence of HDBI, even as Taneo, the core of our evaluation criteria took into account the ESG principles, especially in the beginning about corporate governance, because it is well known that making investments that you are proud of, they have a positive social and environmental footprint, and then you are connecting with them, has become very important in the process. From the international experience, we know that organizations and companies fostering ESG criteria, they are even more resilient, they attract more talent more effectively, and ultimately they offer better returns to the shareholders and their investors. Today, these criteria have become particularly important. They are the focus of eligible financing across the spectrum of banking and financial activity. HDBI sets first the example, and we have integrated and developed the ESG criteria in 3 axes. First of all, in the very operation of our organization at the corporate level, where our corporate governance at all levels, systems, equipment, paperless operation, and strong participation of women in management and in the employees are some examples to set here. Also, in the operation of the fund managers, the general partners, and the funds themselves, in which we invest, where a key element of our evaluation process is the existence of an ESG policy by the general partners, their intention and the procedures for integrating the ESG criteria at both GP and fund operation, and to have an ESG compliance officer, but also to be part of the selection process of their underlying investments. And thirdly, on the investee company level, that is in the operation of the fund's underlying investments, where the fund managers should ensure that the companies in which they invest, they comply with the ESG criteria and, where applicable, with the do no significant harm principles. In addition to the required annual financial reports from the funds, a mechanism for monitoring and reporting non-financial information at all levels is also required and provided. We note here that the measurement, of course, as we heard also yesterday, is not straightforward, as there is an ongoing discussion about what to be measured, the indicators, and the various reported ratings. In banking, beyond the relatively obvious on-off choices for granting or not financing based on ESG features, they may have to do with the cost of money, accessibility to a wider range of products, and environmental sustainability clauses across all industries. Moreover, apart from the investor side, being sovereign, financial intermediaries, or else, specific emphasis on ESG compliance is also given by the supervisory authorities and regulators. For example, recently, the Hellenic Capital Markets Commission has asked large listed companies to provide written non-financial information disclosures for ESG that companies must make in accordance with Article 8 of the so-called taxonomy regulation, which this year is applied for the first time in Greece. Especially for venture capital funds, special emphasis is placed on companies that have a mission to make the world a better place, that they share high values, and that combine both prosperity together with achieving their goal. This is, of course, on top and in addition to purely financial results. Mainly, they focus on companies that incorporate innovative technology solutions, focusing on solving real problems with high social and environmental impact. And indicatively, you can see we are talking about clean tech, agri-tech, food tech, fintech, prop tech, health tech, cyber, mobility and skill certification, industrial technology and content, etc. And I want also to underline here that our innovative open calls that you can see and find on our website, hdbi.gr, abide to a large extent to the above. HDBI continuously involves the framework for the implementation of ESG by working closely with the advisory hub of the European Investment Bank to obtain up-to-date information on best practices from other countries and peer organizations, to adapt them when necessary to our own procedures. Finally, we are discussing also with other organizations, like, for example, the Institute for Sustainable Development, EPLO, etc. Thank you very much.
Thank you, Harry. Thank you very much for your structured and informative presentation. It's very good to know that there is such a well-organized organization in Greece taking care of walking the ESG path. As we discussed yesterday, there are quite a few challenges ahead. So it's encouraging that you are converging towards that route. So let me now move on to our next session, which is going to be moderated or chaired, I should say, by Ms. Tina Mavraki. Just for the logistics, may I kindly remind you all that each speaker has 15 minutes for the solo presentation, and then 30 minutes Q&A with the audience is going to follow. As a reminder to the audience, feel free to submit your questions through the facility, the online facility, and so that the speakers can be engaged in the Q&A afterwards. So let me briefly introduce Tina Mavraki. Tina is a well-accomplished professional with a very rich experience. She started actually from Oxford reading for the famous PPE. And then at some point later, she also did her MSc in finance at London Business School. Tina is a managing director of Ingenios, and she's also serving in the board of directors of Mytilineos, a very well-known and internationally well-known Greek company, which is actually very much focused on ESG as well. Her professional background has involved a number of organizations, including Morgan Stanley, Citigroup, the Noble Group, among others. So Tina, the screen is yours. Enjoy. Hope you enjoy your, the session, and look forward to your insights as well as to the speakers. Thank you.
Thank you very much, George. And this is a beautiful last couple of days. So thank you very much for all the great insights from everyone involved. So I've sat down and calculated that between the three speakers that we have on the panel today, we count 90 years of experience. So I think I'm right in saying that this is a very distinguished panel and an extremely experienced panel. We will try to make our recommendations as specific as possible and to kind of get as many insights and tangible insights across to the audience as possible. So let me start introducing Maya. Maya is a very distinguished sustainable finance expert, leading EBRD's environmental and social work with financial institutions and private equity. She promotes ESG strategies, including integration, ES in investment decisions, financial and risk management. Her career spans almost 20 years in development finance institutions, where they've pioneered a lot of great work in ENS. Maya, do you want to take the stage?
Hi, thank you very much, Tina. Yeah, and maybe because this panel, I was asked to talk about climate, maybe I should give the update to my CV, and I'm now in charge of green financial systems at EBRD. So since we saw each other last time, this is the second year that we're collaborating with the IFFR on this event. I'm very happy to be here again. So thanks for the invite, and thanks, Tina, for the very kind introduction. Shall I start with the presentation now? Or okay, great. So I wanted to bring you a little bit the latest that we've been arduously working on at EBRD over the last year. You may have heard that we have committed to align all our funding with the goals of the Paris Agreement. And when this commitment was made, we all agreed, but we didn't really know how to do it. And then we started looking around and we started trying to identify, okay, so actually, how does a financial institution align its portfolio with the Paris Agreement? How does that actually look like? And how do you do it operationally? And we found that there wasn't actually that much out there. There were no prefabricated approaches that we could just, go out to the market, adopt it, and then run with it. So we basically had to craft it ourselves. And we have issued this first, so we've gone in 2 stages. Maybe I should say overall, let me actually start sharing so that you can see also the visuals to what I'm, what I'm explaining. So we started this journey out looking at our direct investments. It's a little bit easier because we obviously have a ring-fenced, project or corporate finance kind of structure where we can identify very much more easily, let's say, the direct impacts, and we can look at the economic activity, we can look at the company, or we can look at the project finance deal in its sort of, at the use of proceeds and its limitations. So we said, okay, we start off with that. So we developed our methodology for the direct investments. And then we came out just a few months ago with our methodology for the indirect investments. That's, of course, when we, as EBRD, invest in a financial institution or even a private equity fund. And these institutions then work with our money and they on lend or they invested in investee companies and so on and so forth. So we had to see, okay, how do we do that? Because, of course, that financial institution has other funding available, not just ours. Now, our commitment is that our funding is Paris aligned. That doesn't mean that everything that the FI does necessarily has to be Paris aligned, but of course our ambition grew, yeah? So we thought, okay, we really want to work with the FIs and we really want to get them on that journey because we really believe that science tells us there's no other choice. So let me just show here on this first slide, how does this all fit in? So we operate now with two different frameworks. We have, as of the end of this year, all of our funding will be Paris aligned. That means that there will be no financial flows coming from EBRD that go against the goals of the Paris Agreement. Yeah, and that means that our projects, they all need to be characterized by consistent with long-term low carbon climate resilient development. There needs to be a low carbon lock-in risk, and they need to be resilient to physical climate hazards. That applies as of the end of this year to 100% of EBRD financing. And then we continue to have, you probably all know this already, we have our green economy transition approach, which is really the dedicated climate finance, where we go a step further and say, okay, not just do no harm vis-a-vis the Paris goals, but also actually positively impact the Paris goals. And there our ambition is to be a majority green bank by 2025. That means 50% of our new approvals on an annual basis needs to be destined to green, including climate and other environmental finance. So these two ambition letters we have, just for the background, there's two other pieces of the Paris alignment background for us. First, we have, of course, an environmental and social policy. Yeah, we've always had it. That's nothing new. But we need to see those components not in isolation, but integrated with each other. So everything we finance runs through the filter of our environmental and social policy. That means that we apply a rigorous environmental and social risk management as we've always been doing it. Then we've been really working very hard on our fossil fuels approach, and we have a revised operational approach. We have already quite wide exclusions for fossil fuels. Our environmental and social policy excludes already all types of thermal coal mining, coal-fired electricity generation, upstream oil exploration, upstream oil development projects, and so on and so forth. We also last year gone a step further and have actually at an operational level excluded almost all oil and gas financing. There could be a slight exception, but only where those two tests that I've mentioned earlier can be met, namely that there's no risk of carbon lock-in and it is part, the investment is part demonstrably so of a reduction pathway. So this is very important for context because in my strong conviction, you cannot be Paris aligned if you continue to, finance fossil fuels. You cannot be Paris aligned if there is not an integration with a general do no significant harm approach, which is provided by our environmental and social policy. And now let's look a bit further. I'm going to zoom in here on the indirect methodology for Paris alignment because this is really brand new. And again, we couldn't find much out there in the market. So I think we are quite breaking a bit of new ground. And of course, also, I was asked to focus on banking and on the financial sector at this panel. So we're going to look at that. This is the way we're going to work with our partner financial institutions going forward. So the first, it has 4 pillars. The first pillar is there needs to be a commitment to the goals of the Paris Agreement. So any FI that we're going to work with will need to commit that they are working with us or by themselves. If they don't need us, even better, but certainly they will work towards the Paris alignment for all our new transactions from the 1st of January. Yeah. So we will check, we will make sure that there's an affirmative covenant, some affirmative written agreement between us and the partner financial institution. Then the second pillar is more of a transitional thing. It's also more of a prioritization thing. It is our sub-transactions filter. So a lot of the things that we finance through intermediated financing we can consider from the get-go to be consistent with low carbon and climate resilient pathways. Of course, all of our green lines, of course, all of the green bonds that we invest in, they're automatically Paris aligned. A lot of our SME financing, because the tenors are very short, the ticket sizes are rather small. It's also, there is a very negligible risk of misalignment with the Paris Agreement. So where we lend to a bank, let's say, and we know, okay, we have a GEF line with them, a green line, our name for the green lines, then, you know, we don't need to prioritize them immediately for the full Paris alignment assessment, because we know our use of proceeds is automatically aligned. So that doesn't mean we will not work with them going forward. It just means because we have approximately 350 FI clients as EBRD. So sadly, we don't have the staffing to get everybody on board straight away as of January. So we need to go a little bit in steps. So where we know that there's a very low risk, we will deal with that later. Where we see there's a higher risk, and that is particularly the case where we cannot ring fence our use of proceeds. That's particularly the case where we have, for example, general use financing, where we take equity in an FI, or where we, for example, invest in any general finance bond issuances, for example. Then we will prioritize. And what we will do is we will do a Paris alignment counterparty assessment. We will run through an assessment, through a due diligence process with our partner FI to really see where do they stand on their journey to getting an alignment with the Paris Agreement. So we will look at what climate action they take. We will look at what climate commitments they may have made. Maybe they already have a fossil fuel divestment strategy. What also, in which regulatory markets do they move? Regulatory provisions in some countries already require a little bit more than in others. So, and then we will see, okay, on which step of the journey are they? Are they just very in the beginning? Are they already quite advanced? Or maybe are they already leaders in their field? And then depending on that outcome, we will move to the fourth pillar, which is agreeing with our clients a Paris transition plan. So here, obviously, between the step 3 and the step 4, there will be a lot of engagement. We will help clients with, capacity building. We will help them with workshops. We will help them with consultants. We will help them everything that's needed so that they can really for themselves figure out, okay, what does Paris transition mean for me? What does it mean with my lending strategy? What does it mean in my regulatory framework? And then eventually the FI will draft its own Paris transition plan, and we will obviously look at it. We take a view on it. If we see it's really not sufficient or appropriate, we will rely on our usually very good client relationship, and we will work with the client to get those transition plans to a level that we think is appropriate to the undertaking. So, and then of course there will be the implementation phase where we will of course not abandon our partners. We will be there to support if they struggle with the implementation or when, things may change. This is the way we're thinking of doing it. I'm going to stop sharing. I do not have more slides. I did not want to bore you with many, many slides of PowerPoint. But just to say, we're very excited about this. This is really a departure for us on working with our financial institutions, with private equity funds, with insurance companies in a much more holistic way, because we're getting away from this very narrow concentration on the use of proceeds, on our lending, and we'll really work with the financial institution very holistically. And in addition, we will back this up with outreach, of course, to regulators, policy dialogue, policy products. We have fundraised successfully a rather large technical cooperation facility, which is called the Climate Corporate Governance Facility, through which we have now quite a good basis of TC funding available to really support our clients once the assessment is done and we know what they need to work on, so that we can also really be their hands-on partner and not just ask for them to figure everything out by themselves. So yeah, we're very excited. This is really becoming part of our overall banking strategy. So Paris alignment again, it applies to 100% of our financing as of the end of the year. So it will be part of our very normal dialogue with our banks, with our funds. And we just don't think that the future of banking can ignore that anymore. So we're starting to do it. We'll see how it goes. I'll report back next year at this time. Thanks, Tina.
Fascinating work. Thank you so much, Maya. I understand that you've already been testing this environment for the last year. So we'll get back to you with a few questions, and I bet the panelists will want to quiz you on a few things in that matter. But let's move for the time being to Desiree. Desiree, it's an absolute delight to have you at the panel. Desiree is a very widely recognized advocate for change in ESG investing and sustainability, and is a strong advocate against greenwashing. She has held very senior positions with world-class institutions, most recently as Group Sustainability Officer for DWS. Desiree, please, the floor is yours.
Thank you so much. Thank you so much for this opportunity to present. Before bringing up my slide, I just wanted to start by addressing the very provocative speech given by Stuart Kirk, the global head, or perhaps former global head of responsible investing at HSBC. He delivered this speech last week, and it was widely reported on by the media. So I'm sure many of you have read about it. So I'm not going to discuss, or even for that matter, judge his very strong views on climate risk today. Look, it might be very different from my own, but that's fair enough. We live in a free market. We're supposed to have differing views. Look, taking the other side of ESG and doubting the adverse economic consequences of climate risk, is allowed. But, what concerned me, or the questions I have around this controversy, this incident, was really focused on governance and fiduciary responsibility, right? Did Mr. Kirk, while selling ESG products and while promoting HSBC's responsible investing credentials, spin a different story to investors to sell these ESG integration products or ESG dedicated products to investors, while he and his team, doubted climate risk assessment and potentially just dismissed it internally, which of course brings me to my subject matter, greenwashing. If that was the case, that fiduciary responsibilities were breached, this could be, an example of a very big greenwashing situation here. So I'm just going to bring up my slide right now. Just bear with me. Sorry about this. Excuse me. Okay. And here we go. Suffice it to say, given my recent experience, I get a lot of questions around ESG washing and greenwashing, and mainly around how do we prevent this, or at least mitigate this in the market. So I thought it might be helpful to discuss, some tips and principles, that ESG investment platforms can use, again, to up good practice at the firm, but also, to mitigate ESG and greenwashing allegations. We know that the ESG market lacks standardized definitions, standardized reporting requirements, standardized impact measurements. And we have some really good initiatives happening right now to address, right, these issues. Of course, We've got the ISSB's reporting initiative happening right now. Of course, folks are aware of the SEC climate risk disclosure proposal, hopefully in the hopper as well. So while we're waiting for these these initiatives to happen, let's work on just supporting good practice when it comes to ESG investing. So first up, what I have is really an organizational tip. Make sure ESG is embedded throughout the platform. It's not an island onto itself, right? You don't want a situation where the left hand doesn't know what the right hand is doing. And you want to ensure that there's alignment of ambition, of principle, of vision, of operating strategies throughout your entire platform. The second point I make is one on disclosure, right? We know that when it comes to impact, it's very subjective. We also know that there's a wide range of ESG strategies, from ESG exclusion through to high developmental impact. So the way to address this is just, very simply, is with transparency, clear disclosure on products and services. And that means, be clear on your communication about the investment product's objectives. Be clear about definitions, right? So be clear what type of strategy you're running, and the use of risk assessment, right? ESG integration is not yet universally, it's not a legal definition. Make sure that you are fully defining what you mean by ESG integration. Be clear on targets and the metrics that you have to indicate environmental or social performance. And also be clear on your sources of data and how you aggregate it, right? Too many times we hear firms, touting their very sophisticated ESG risk assessment systems. And then when you lift the hood, you find out the asset managers just simply took in a feed from MSCI, and portfolio managers, might have taken a look at it, might not have, right? So you want to be clear on the sources of external data, whether or not your internal portfolio managers and analysts are also, utilizing fundamental analysis and ensuring they are considering these ESG risk and opportunity factors, the data collected by themselves or through external third parties, and that is integrated, embedded throughout the investment process. Next up, the third point I have is around corporate engagement or stewardship and transition strategies. So a number of diversified asset managers, of course, currently, have holdings in, if you will, dirty industries. They might be investments in oil companies. And today, what you often hear is asset managers saying, look, rather than divest, right, and just trade it to somebody else, right, who's going to hold it with the same, emissions, the better and the more impactful strategy is one of transition. We're going to be activist shareholders, and we're going to engage the company and support a transition to greener pastures. Move said, energy company that has majority fossil fuels in their portfolio, to a majority of a clean energy portfolio, as an example. Now that's great, right? Again, that is, fair enough. That's a fair strategy, but make sure there's evidence behind it, because today, so many folks and asset managers are touting, right, this transition strategy and their corporate engagement, and just showing the number of meetings they're having with investees, having meetings is good, right? But that's not the outcome, right? You know, we need to move to a more evidence-based mindset. So if you are touting your stewardship credentials, make sure you're focused on outcomes such as publishing your proxy voting record in support of ESG, AGM motions you might have made, your lobbying practices. Be clear, be transparent about that. And also, very importantly, how you're engaging with the public sector, right, in support of climate risk mitigation, as an example. The fourth point is one on conflicts of interest, right? And this is really about, you know, good governance, right? Admit it. Admit that there are conflicts of interest. It's natural, right? We're talking about, you know, very complex matters, right? There might be a conflict of interest between your sales force, right, on very lucrative pension mandates, you know, while portfolio management or your stewardship practice is calling out said company, right, on you know, on their carbon footprint, right? That is very, that is a natural conflict of interest. Or when, you know, the executive division might set a net zero commitment, right? And portfolio manager of a non-ESG fund is saying, wait, hang on a second, you know, I'm, you know, loaded up here in oil and gas, like, you know, no one gave me the memo. So, you know, again, this is, you know, it's human nature, right? This is a long-term journey, right? It takes time. And the best way to manage it is to admit it, right? And you're, you know, you start, right? And if you've made a net zero commitment, you have to do it, right? You know, but, you know, set, you know, increments of you know, interim targets and make sure, you know, you are addressing it. And again, the best way is sometimes through Chinese walls, or, you know, just you know, sometimes it's just, you know, again, you know, the C-suite saying, you know, look, this is happening, you know, get on the program. But you don't want to be, you don't want it to turn out where you're not aligned throughout the platform, and you are properly addressing these very natural conflicts of interest. You know, the fifth point that I put up is, again, walk the talk, practice what you preach, right? If you're selling it, hopefully you better be operating with those same principles. And that's, you know, again, everything. If, you know, again, you have a focus on selling a lot of green products, climate action products, you know, make sure that you're focused on your own, you know, GHG emission profile. You know, again, if you're touting social issues, you know, make sure that, you know, again, you're focused on your own company's, DEI objectives and targets, right? Make sure that, you know, again, you're reflecting the principles that you're selling in your products. The next point that, and just one other point on that one. Today, very often we confuse inputs with outputs, right? It's amazing how many times you hear a company coming out with the mission statement around net zero or diversity, you know, or, you know, applauding themselves that they've hired a sustainability officer, or they've set up a sustainability committee. They have a human rights policy, right? Please note, like, you know, those are all initiatives and tools, right? Those are just inputs. Those are not outcomes or results. And too often today, we're paying ourselves up, we're, you know, boasting about our aspirations, right? And our inputs, and we're not focused enough on performance results and outcomes. And that's very, very important. There's way too much PR, you know, around these inputs, and not enough attention on and promotion and focus on action and outcomes. The next point is kind of obvious. Don't overcharge for ESG, right? It's really anti-ESG if you're ripping off your clients in the name of ESG, right? Bloomberg has done some very interesting research reports on ESG ETFs, versus non-ESG ETFs. And, one point they make is that there's incredible correlation between the portfolios of the two, yet there's a difference in fees, right? That's not okay. That's not cool. Make sure that products are appropriately priced. And finally, the last point is, it's all about governance, right? Make sure, you yourself have strong governance and allow a speak up culture. These are, highly, complex matters. It is a long-term journey. There are different views. It's so imperative that groupthink doesn't set in, that different views are heard. Of course, command decisions have to be made, right? A CEO and a C-suite has to lead a firm, but it's so important, right, to hear all the different voices on either ambitions or views, or really what's going on internally. So at the end of the day, we know that the best means to mitigate, greenwashing or ESG is probably, and that's like my bottom statement, right? The best way to mitigate it is really through, regulation, real oversight and enforcement. I mean, there's nothing like an SEC enforcement action that will make an ESG executive think twice about greenwashing, no doubt. But in lieu of regulatory action, standardized definitions and reporting requirements, I think, the onus is on us to sum this up, to be as clear and as transparent about what we're doing. We need to develop a mindset and practice that's as painfully accurate around non-financial disclosure as it is around financial disclosure. So that's it. Thank you very, very much.
Well, thanks to you, Desiree. You've highlighted a lot of very critical points here, and I think a lot of people will be coming back to you. I take your point basically about consistency, congruency, and being consequential in what you're saying. So let's hold these thoughts, because we're definitely going to be coming back to you. And it's time to introduce Mark. Mark is a senior advisor to companies, investors, and NGOs on environmental strategies that make business sense. His experience spans some 40 years, if I've calculated this, Mark, correctly. Previously as CEO of the Nature Conservancy, and the biggest environmental NGO, and partner at Goldman Sachs and managing director, where you actually pioneered ESG thinking back in 2009, as I remember you sharing. So, Mark, over to you.
Okay, thank you, Tina, for the nice introduction, and thank you, Maya and Desiree, for your really encouraging remarks. A pleasure to be here. So yeah, I've spent most of my career, decades really, on the idea that the private sector can be a real champion, a real change agent for addressing environmental challenges. And maybe I was a little bit ahead of my time, but today there's a lot of really exciting and positive stuff going on. So I want to note those positive activities, and indeed, I think we can be very encouraged by what the private sector is doing. But on the other hand, really the point of my remarks is, I want to also make a note of caution. As impressive as these voluntary efforts are, I think they are insufficient. And all of the participants in the voluntary sector need, in my view, to turn their attention to the need for public policy. By the way, everything I say is based on kind of real world conversations with CEOs and fund managers and NGO heads. I'll note, since the pandemic, I've only been working in the US. Most of my career was very global. So my comments are a little bit weighted to the US, but I still think although every part of the world is different here on the regulatory front, I think it still holds water globally. Despina is going to help me with my slides. Can I have my first slide, please? Just bear with us. I'm traveling. That's why I don't have the technology to do this myself. Okay, so let me review what's happening in the private sector. So this is my first slide. There's been an extraordinary burst of activity, and you all know this, coming out of the tech sector, and it's extremely encouraging. I think this is the single best thing going on the climate front. I was just in Silicon Valley last weekend, and so many young entrepreneurs are focused on really great strategies, really great technologies, all of which can make a material difference in addressing the climate challenge in a way that makes business sense. I just note some of them here. This slide could have gone on and on. It's very exciting, very positive. But even here, I want to note, many, maybe most of these new business strategies ultimately require better policy to succeed. Take direct air capture, for example. So many companies are focused on carbon removal in a permanent way, but of course, it looks like it will be rather expensive to do this, at least for some time. And query, can we really expect companies to voluntarily pay up for expensive direct air capture? Or the same thing is true for green hydrogen, an enormously important opportunity with lots of potential. But again, the business models are a little bit unclear in how they can work commercially without policy. So I want to emphasize this is positive, but I think really the players in Silicon Valley and their counterparts all around the world should direct more attention to the need for policy. Next slide. Okay, here I note quickly, I think this is really positive too, although it's a little bit weird. You have companies like Walmart and Apple, enormously important companies, right? Apple, until recently, the most highly valued company in the world. Aramco just knocked it off that spot. And Walmart, the biggest retailer in the world, very sophisticated in managing their supply chain. And you can imagine if you're a supplier to either of these two companies, these aren't the only two, but if you're a supplier to any of these two companies, almost nothing is more important than succeeding in supplying Apple or Walmart. And Apple and Walmart are now demanding or pushing very hard for their supply chain to decarbonize. So at a time when, in my view, governments are not insisting on that decarbonization, these two companies are using their clout as huge customers to push for that kind of decarbonization. So again, I say very positive, and thank you, Apple and Walmart. But in my view, when I look closely at what's happening right now, I think this is going rather slowly. Because those suppliers, like take a Walmart supplier, Walmart's famous for demanding its suppliers have very thin margins so that they can sell goods to their customers at low price. And now as we enter tougher economic times, as there's so much pressure on business, query, can those suppliers really afford to do the decarbonization that Walmart wants voluntarily? So this is worth keeping an eye on, but I don't know that Apple and Walmart can take the place of government here. Next slide. All right, this is the most visible of voluntary initiatives. I think we can all be quite encouraged by the thousands of companies and also financial institutions signing up to make net zero pledges. And I want to recognize and thank the many environmental activists and NGOs and organizers who have worked so hard to make this happen. This stuff is hard to do. I know firsthand from my days running the Nature Conservancy. And I don't really think this is greenwashing. I mean, there may be some bad examples, but by and large, I think the CEOs who have signed up to be net zero by 2040 or 2050, they mean it. But let's face it, that's a long time from now. And again, I think if you look very closely, progress is slowing down, not accelerating. As soon as companies achieve the easier decarbonization moves that they can, the ones that don't cost too much or obviously pay for themselves, things slow down. And I think it will only become more challenging now in tougher economic times. CEOs tell me they can't afford to take big bets on technology, which ultimately require policy. They want to see the policy first. I think that's reasonable. Or they tell me they can't afford to raise their own costs significantly if some of their competitors don't do so, because then they'll be at a competitive disadvantage. So again, I think this is a positive thing that these companies are all in the game with their net zero pledges. And I think disclosure, which will improve, will help. But again, query, can they really do it on their own, or do we need rules and regulations? Next slide. Proxy Advisors, these are two big of the two big firms that in the US, ISS and Glass Lewis. These are the kinds of organizations that advise institutional shareholders on how to vote on shareholder resolutions. So you'll all remember 1 year ago, engine number one, a hedge fund with a rather small holding in Exxon, orchestrated a shareholder vote, and there was a change in directors at Exxon, and Exxon subsequently has, I think, really progressed in its climate strategies, a very positive strategy. But again, I'm nervous that this is a strategy that has limitations. More recently, in this year's shareholder resolution season, and it's happening right now, it's shareholder meeting time, shareholder resolutions on climate front are mostly losing and getting smaller percentages of the votes. And again, I'm all for people trying, and I think this dialogue and the back and forth and the attention is all positive. But you'll see people are saying, listen, we can't really micromanage companies and tell them how to operate and how they should do business in connection with decarbonization. That's no way to run a business. And so again, I'm cautious here that shareholder resolutions, although positive, and they keep the heat on companies, and I think that's positive, can really lead to systematic and scaled decarbonization. Next slide. I only have a few more of these. Oh, this is another great one, tech giants. These aren't the only two, but Google and Microsoft have both said that they plan to source 100% of their energy 24/7, 365 from renewable energy sources, not using certificates, RECs, et cetera. And of course, this is hard to do in some places. Like in my international days, I spent a lot of time in Taiwan and Singapore, and those are small island countries where there are limits to the amount of green energy that the power sector can provide. But Google and Microsoft are saying, we don't care, we insist. So I think this is positive. But again, it's kind of an odd strategy where the more straightforward way to do it and the more cost-effective way to do it would be for the government to impose increasing requirements on the utility sector to transition to ever bigger amounts of clean energy. In the US, we've had pretty good experience here with so-called renewable portfolio standards. More than half of the US states have them, and every year they ratchet up the supply of clean energy, and it's actually gone pretty well. We've run out of momentum, and President Biden tried to accelerate this in his failed infrastructure bill. And so I thank Google and Microsoft for leading the charge, and I think it will lead to positive outcomes. But really, I think what we need is the policy that they're seeking to be a surrogate for. Next slide. So is any of this sufficient? Of course, my answer is no. And I think this is a big deal because we wouldn't want these voluntary initiatives to lull people into the point of view like, well, this is great, even though government policy isn't where we need it to be, we can rely on all this private sector voluntary action. I don't think we can. So while it's all positive that this action is underway, I think there's a risk in that it tricks us and we're more complacent than we should be in terms of the need for policy. Next slide. So what's missing? This is just one quick list of what I think we need on the policy front. We can all have different points of view, and every jurisdiction I think is a little bit different. And of course, politics is hard. It's harder now than ever before. And so part of the game here is to determine what will have real traction and accomplishment, but is politically viable. But here are some of the proposed policies that I think, in fact, we might achieve if we tried harder. And they would all address the shortcomings that I just talked about in talking about these voluntary initiatives. Indeed, one silver lining of the voluntary initiatives is I think many of these early movers, take a CEO who's made a 24 net zero pledge. I think many of those CEOs are now realizing my life would be easier if I were required to do this and my competitors were required to do this. It's much more difficult for me to do it on a voluntary basis. Next slide, please. I think my last slide. So what's needed? Okay, now here, sometimes people tease me. I live in Washington, D.C., and when I talk about policy, they say, oh, Mark, you're so naive. But I think sometimes you do need to be naive or think big. And I can imagine, if you think about all of the different players who have made the voluntary stuff get underway that I just talked about, I mean, in order by memory, venture capital investors, startup entrepreneurs, big corporate customers like Apple and Walmart, companies who have signed up for net zero pledges, and all the NGOs who help them do that. Google and Apple trying to make 24/7, 365 green energy happen around the clock. All of those folks, number one, they should be proud of themselves. They've taken us a long way. I think they're all heroes. But I think they also should now look back, reflect, and say, boy, can we really do this? Or now is it the time to turn our attention and energy to policy? And then what I would ask them to do in particular is then say, well, can we form a kind of coalition? It would be a weird coalition of unlikely partners, NGOs, environmental activists, companies, proxy advisors, and push hard for the no regret, common sense policy that we need. I think there is an opening for that. And I think if we don't do that, we really risk losing momentum in the period ahead and falling behind our decarbonization targets. Thank you very much.
Thank you so much, Mark. This was a fascinating presentation. And obviously, the thread, unifying thread of all your slides was policy. So I understand we have a few questions already. This is the stage where we will be breaking out for 30 minutes and taking questions from the audience. It is quite clear that all of you more or less are advocating for policy, and rightly so. It's not just in the US, but across the globe. That's the increasing kind of consensus that's shaping up. So if I were to turn the table back to you guys, all of you, what would be the 3 specific policies that you would be recommending to regulators? Because ESG is a younger body of knowledge. It is an evolving body of knowledge, but nevertheless, it's a very disciplined body of knowledge that's developing constantly. So in the spirit of developing this debate further, what are the specific policies you would be recommending to the policymakers right now? Governance, disclosures, specific stuff. Who wants to go first? Maya?
Yeah, I just wanted to, before we go to the specifics of policy, I think I fully agree with Mark, but I think it's also important to note it goes both ways, right? So neither do we want private sector to sit back and wait for government to fix it on the policy basis alone. I think we all, I mean, the time that we have left is so short. It's upon, I think we need all hands on deck. So everybody needs to figure out from their specific corner what they can contribute. So policy is absolutely key, but we need to be careful not to sit back and wait for policy to fix it alone. That's just a comment on the side. I think the basic thing we would need to address, and it was also in Mark's presentation, is certainly the price on carbon. This is such a basic thing. I think as long as we don't have a price on carbon, the externalities simply aren't priced in. So all our finances, all our financial modeling, you know, it's just not priced in, and that extends to the price on natural capital. So that for me would be a basic one. Again, I'm realistic. I know it's politically not a simple thing to do, but that would be a massive shift. And then the second one is certainly, and we're seeing that trend obviously, is the regulation side. It's a bit like reverse engineering, I always say, because of course the disclosures and is only the tail end of what we're trying to do. But I have seen, by working so closely with so many, specifically financial institutions, but also corporates, when ESG or climate disclosure regulations come in, they really question, or they really have to set themselves up almost again, or they have to revise the whole internal ESG or climate governance, because they, in order to be able to report in an appropriate way on the material issues, you have to be able to identify them. So you have to build internally the capacity to really analyze your business activity, analyze all the positive and negative impacts, measure them, monetize them ideally. And then, you know, all of this requires a specific internal governance and a lot of internal capacity. So the tail end of the disclosure sometimes is like reverse domino. It sets off a process whereby institutions really get the house in order, and then they come out much stronger at the end. So I would say those two things: price on carbon and disclosure.
Disclosure and governance, by the sound of it. Okay. Mark, your name was mentioned. Do you want to go second?
Sure. Thanks. Yeah, I agree. Price on carbon would seem like the no-brainer, or a cap and trade program, and one that ratcheted up quickly. It would give the private sector clarity on what the rules were and the outlook. However, especially in my home country, the US, there isn't very much likelihood of such policy today. That's, I think, unfortunate, but it doesn't mean we're stuck. We can just shift our attention to industrial policy. It's ironic that in America, at least, all these folks who are pro-free market are opposed to a price on carbon. That'd be the free market way to do it. Let the economy determine where the cost reduction. Use industrial policy. So I mentioned earlier, renewable portfolio. You just incentivize.
Mark, we might be losing you. You're coming off intermittently.
The heating of buildings. And again, they provide certainty. They're easy to understand. Not easy, but not as difficult. And then third, I would say tax incentives for new technologies like green hydrogen, carbon capture, et cetera. There's really exciting technology. We're so close to it, but we need a little push so that the private sector can go a little bit harder. You know, I mentioned Exxon earlier. So it's a good story of the private sector. Exxon's changed a lot. Exxon has said they're now in the low carbon business. They seem to be mean business. They're focused on green hydrogen and they're focused on carbon capture. That makes sense. It aligns with their, you know, core capabilities, but they also say we need policy support, or otherwise, at least right now, it doesn't make commercial sense for us to do that. So those are the kinds of things I would note. Disclosure, by the way, would be one area where I think we could make more progress on a voluntary basis. That's what I always tell CEOs who are if they're mostly doing good stuff. I say, you should disclose more. You don't get enough credit for what you're doing. You know, don't have these fancy glossy reports that are hard. It's hard, they obfuscate what's really happening. Just in a very straightforward manner, spell out what you're doing, maybe spell out what you're not doing, and why, you know, to the extent costs are too high, et cetera. But disclosure could go a very long way. And that's something I think we could get more of without rules. Thanks.
Thank you. Desiree, your thoughts?
Sure. You know, listen, I agree with everything that's been said, so I'm not going to, I totally support it. So I don't have to go there. It's already been said. The only point that I would make is that with new legislation or with new regulation, too often we see the policy out there, but we see lack of real supervision and lack of enforcement. And I think that's key. I mean, that's you know, I'm also critical of a lot of stuff that happens in the US and, you know, some of the disregard for climate risk. But one thing the US does do well is our regulatory bodies do supervise and they do enforce. And there's nothing, I've lived through the great financial crisis, there's nothing that cleans up, right, you know, industry bad practice than, you know, a hefty SEC fine or a threat of an arrest. And so that's, I know it sounds harsh, but it's very important. And I think in Europe, you've got, a wide range of regulations around sustainable finance. It's very important if you really want to mitigate the bad actors that aren't delivering on commitments, right? It's through actually enforcing these policies.
Thank you. The questions keep pouring in, so we'll have to time our answers here. I'm getting a few questions which I can sum up as a bit doomsy for ESG, to put it in kind of words here. Stuart Kirk simply said that what most professionals in the industry believe. So is there any hope for ESG after all? That's number one. Number two, the Ukrainian crisis have proven that countries are not interested in ESG. For instance, Greece has turned towards coal in contrast to initial declarations. What are your views on these? What are your views on this? And the other one, why is climate such a significant risk? The most significant risk could be, why not a pandemic? Why not another credit crisis like 2008? Some very esteemed people like John Cochrane argue that climate risk is just a subterfuge for policymakers to allocate capital from some companies to some others. So a few kind of negative waves towards ESG. I didn't feel that we had to defend this at this stage, because if anyone would want to look at specific numbers, they could go to the insurance industry and understand what are the effects of transition risk or physical risk, and they can put a price on them. But if we have to address these questions, which we will obviously, what would be 3 words from each of you? Any in any order.
Maybe I'll just jump in.
Oh,
sorry.
Oh, I'm sorry. Go ahead, Desiree.
Desiree.
So just quickly and just off the cuff, I would say that, look, there's no doubt. Let's just be very clear. ESG is not a guarantee of outperformance, right? This year has made that, like, that is not, to my knowledge, there's no research that backs that up, right? It's, thank goodness, it's no longer what was used to be considered, right, charitable and will lead to underperformance. But this year, what we've seen is a lot of ESG strategies around technology companies, carbon light companies, and obviously those portfolios are trading off, and those that had those excluded bad sectors, oil and gas, is trading up. And what I would say is that, again, there's, cynicism is sinking in. I think, Stuart Kirk's, statements are a bit opportunistic as well. I would just say this, look, there's a generational difference between like boomers and even my Gen X and millennials, right? The younger generations are very, very focused on investing, value aligned. They're very focused on, climate action. And again, unfortunately, Tina, like you said, we are experiencing increased random and adverse weather patterns with catastrophic effect, right? And I think that, so as a result, the focus on sustainability and whether it's like loss of biodiversity, again, these, bad weather patterns, right? It still is a focus. It might have ebbed from the crazy irrational exuberance that ESG had a few months ago, but it's definitely here to stay.
Mark?
Well, I agree with Desiree. You asked a bunch of questions, Tina. One of the questions was, why all the focus on climate? So from a business perspective, I think it's pretty straightforward. Not addressing climate poses enormous risks to the economic outlook. And most CEOs, I think, get it. I don't think most CEOs agree with Stuart Kirk. I think they look ahead and say, my goodness, climate is horrible for the business outlook, and it gets worse and worse. More importantly, when we look ahead and say, well, if we did everything that made sense to address climate, beyond climate, is it good for the economy? Yes, it's very good for the economy. Addressing climate means lots of investment in exciting new technologies, which not only result in addressing climate and improving climate outcomes, but improve human health, create good jobs, clean up our cities and streets. This really is a win-win. And, I'm repeating myself, the voluntary stuff has gotten us some real momentum. With the right policy initiatives, we could be on a pathway that is good for the economy, near term, long term, also good for the climate, good for biodiversity and people's health. It makes all the sense in the world, in my view, for most business people. And I think this guy, Stuart Kirk, I don't know him, was just plain wrong.
Thank you. Maya?
I would just add to that very quickly. I think this disgruntlement about ESG may also have to do with the fact that we need to be honest about the fact that ESG is really hard. It's not, it became a big trend, but it's not a quick fix. It's not a quick win. Yeah. It is really, really hard. When you have to put your wellies on your feet and go out on the side of a potential investment, and you have to actually assess the environmental and social risks. You have to undertake stakeholder engagement to find out what the communities are thinking. It is a really hard job. So there is no quick fix to get, you know, a quick win out of an ESG approach on you know, a couple of pages of your Word document. So that may have something to do with it in my view. And then I think the second question is, we need to also be maybe a bit more clear about what we mean with ESG, because if, you know, Elon Musk last week tweeted about the phony, you know, approach of ESG and so on and so forth. And again, you know, if you have, again, it is really hard and really complex. If you have an investment or if you have an economic activity that's 100% green, but I'm not saying this is the case for Elon Musk, I'm just using it as a hypothetical example. But you have, let's say, forced labor in the supply chain, yeah, you may be 100% green, but you may not have, you know, an integrated round ESG approach. So again, ESG has a lot of shades. It has a lot of different subtopics. It requires a lot of expertise, and so it's not a quick win. So we need to be really honest. What does ESG mean? And we need to be honest about the fact that it's not easy to get it right. But I also think it's absolutely there's no alternative to it, because obviously the traditional economic model has not served as well.
Thank you so much, Maya. So I think we have time for one final question here. So you've all worked with financial institutions, and if I were to ask you, what are the 3 indicators, the top indicators that you could identify to pinpoint and or appreciate that there is no greenwashing in that financial institution, what would they be? Desiree, I think this is this has your name on it.
Yeah. Gosh, let me see if I can do this
as specific as possible.
Okay, so I would start off with the org chart, right? Make sure they're just, you know, you're not just, you know, grabbing and repurposing some individuals for PR purposes and slapping like sustainability officer on that person. Make sure, right? Just like, you know, everyone working in a business has to understand regulation. Make sure that there's ESG competence throughout the platform, right? Number one. You know, the second thing has to do with probably the integrity of the products, right? Again, make sure this isn't, you know, a marketing exercise. Make sure that there's, you know, that there's clear disclosure on the products and that the label reflects what the product is. You know, I'll just give you an example, like investments in Microsoft, Alphabet, and Apple, United Healthcare. I mean, I'm sorry, but that's not Sustainable Development Goal aligned. That's not Article 8, right? That's a, you know, a portfolio of high performers, of progressive companies navigating the modern world. Maybe it's Article 8. Right, but just make sure there's integrity, you know, and there's evidence, right, and data, you know, but behind how you're labeling and marketing the product. And then finally, like company action, right? If you know you're selling these principles, make sure you're living these principles. Make sure you are going net zero and not just gaming it a little bit with a little renewable energy intake here and there, right? Make sure that you're doing your best, you know, on tackling scope 3 as much as you can and living your diversity principles.
Thank you, Desiree. Maya?
I think you've actually mentioned it before, Tina. I would say definitely the backbone is the governance. So every institution, whether it's financial institution, corporate player, they need to set themselves up internally in a way that is conducive to having everything that Desiree has actually described. So if the board is not regularly served up with environmental social performance data, and they're not scrutinizing it in the same way as they scrutinize financial data, then, for example, you already have a gap there. If, you know, sustainability is not measured, then, you know, what's the benchmark? What are you producing there? You know, if there's no second line of defense and a validation and an MRV of what you're, you know, saying that you're doing, then again, you know, the incentives are not in favor. So I think, you know, robust internal corporate governance, both for climate and for overall ESG matters, is the backbone of this whole exercise.
Sure, thank you. Mark?
The only thing I would add is transparency, disclosure. Again, I mentioned this. I think it's easy to do. If you're a good company doing your best, doesn't mean you're perfect. This is hard stuff. Just spell out as clearly as you can how it's going. I think an example I would point to is Microsoft. I mean, maybe it's easy for them. They're a very profitable company, but they have super ambitious carbon removal goals by 2030 to have removed all the carbon they've historically emitted. And they report on that in the form of a memo that is, you know, anybody could understand. And they say, this is what we're doing. So in their case, then, these are the removals that we're buying. Here's who we bought them from. Here's what we paid. Here are the outsiders who are vetting these projects for us. Here's where we'll acknowledge we're a little bit nervous. We don't know if it will work or not, but we think it's a risk worth taking. And I think it's really smart disclosure because it's pretty hard to criticize them then. They lay out what they're doing and why. All makes sense to me. They don't admit they're perfect or they figured it all out or they can predict the future perfectly. They promise to keep reporting on it. And it looks to me also to be pretty easy to do. Just tell the truth. Again, as long as you're not a bad actor, the truth shall set you free.
Thank you, Mark. Thank you very much. It looks like we have one more, the opportunity for one more question here. And this is something that is coming up a lot these days. ESG measures being mandatory, prices of products will have to go up. A lot of the people who are living in poverty might not be able to afford higher prices. Now, does a subsidy from the government, is the subsidy from the government going to help this matter? Or how would you imagine the government or commercial sector helping to tackle this problem? Maya?
Yeah, I was just thinking, do they mean that the prices go up for the end consumer, or is that the end consumer?
The products are going up, the prices are going up because the cost of ESG is higher. So how will people afford this?
Well, I mean, we are looking at this whole, at a high level, we're looking at this whole transition also, of course, under the tagline that you surely have heard about, the just transition, right? So we do need to make sure that as we transition to you know, the low carbon future, that nobody should be bearing the price. You know, those that are most affected should not be bearing the price. Let's put it that way. So we are doing a lot of work around that in a number of platforms, looking at what just transition means, how we differentiate between what is just transition, what is transition to green, where's exactly the field in the middle, what do we need to do? And just transition also means to not only look at, you know, I don't know, developing countries versus industrialized countries. It also really looks at the disadvantaged communities within each setting. So I'm not sure exactly on the specific of subsidies. That's a question, I guess, of specific commodities and what we would need to look at. But overall, the idea of just transition is very central to this debate, and we're certainly looking at it.
Mark, what do you think?
Well, it's a really good question. We could do a whole another session on it. There's no easy answer, even though I was positive about the ultimate economic outcome of the transition to a clean economy. Of course, in the near term, it's very disruptive and it's expensive to decarbonize. And so, yes, there needs to be an effort to ensure that the less well-off don't bear the brunt of those costs. By the way, I'll remind everybody, though, too, if we don't address the climate challenge, it's the less well-off who are exposed to the risks that go with it. But this is a perfect example of where we need public policy that addresses these issues. In my view, no matter how hard the private sector tries voluntarily, they can't address this. We have governments for a reason, and it's to ensure just transitions. We need policy here.
Yeah,
what are your thoughts?
I absolutely agree. So, as Maya said and Mark said, there is a focus on environmental justice. And, just to sum it up, it will have to be, there's no simple solution, but it's through, private public partnership, to address this, to ensure the most vulnerable, aren't paying the most, right? And that is addressed. Thankfully we have that mindset, and it's going to take time to work on those solutions.
And maybe Tina, just to add one comment, this is why we have the S in ESG, correct? It's not just, so we cannot look at climate completely separately and then ESG is something else and we don't know really what it is. I mean, there is an S there for a reason, and that really is to make sure that the social concerns are addressed appropriately and mitigated, minimized, and so on and so forth, like any other impact. That's why it is ESG and not just the E.
If I were to focus on the E though, and we have divestments in oil and gas, and that's a question from the audience. Isn't that going to increase volatility in energy and increase the risks on the energy security side? Who wants to take this?
My own view is divestment has been, it's a weird concept, right? To sell your shares to express your point of view, and who knows where the shares go, maybe to a less enlightened holder. However, I can report on a firsthand basis, the CEOs of big oil companies, they don't like when Harvard or Stanford say they're divesting, and it gets their attention. So I think it's one more example of initiatives by volunteers away from government to put pressure on companies to do more. So it has served a purpose, but I think there's a limit to how far it can go. And then I'm going to repeat myself. And now we need regulations to enforce better action. But I say, I salute the crowd that's pushed for divestment, even if you don't think it's intellectually the smartest strategy. It has an impact. CEOs and boards notice, pay attention, and it gets their attention and pushes them to act.
If I were to refine that question and speak about divestment of assets, producing assets, not stock or bonds or anything in financial institutions, what would your take be?
I think that's a less good strategy. If public companies sell their assets to private companies, and they're subject, therefore, to less scrutiny, we might be going backwards. I'm not a fan of public companies selling difficult assets.
And if we were to look at global energy security as a whole, and we were talking about a global divestment here, what would your take be? So I'm refining the question again. So if we were to divest globally from the energy mix, from the fossil sources to renewable sources that are more intermittent, what would that have as an impact for volatility and for energy security? What would be your take on this?
I think we're seeing right now with the geopolitical situation and the war on Ukraine, how dependent we are actually on oil and gas when this is not favorable for us at all. And I think this will be and should be a tremendous push for expanding our renewable energy generation and more independence for many of the countries that are right now clearly, very dependent on Russian oil and gas, for example. So, for us as a large investor, I mean, I find sometimes the argument, to be honest, a little bit lazy to say, we're going to stay with the oil and gas companies so we can change them from within. Yeah, but on the other hand, if I can put my money into, a wind farm instead, then I think we've achieved much more. So we as an institution, as a financial institution, we have made that decision to not invest anymore in fossil fuels. And I think for us, that's definitely the right decision to take. We cannot claim that we are Paris aligned or that we have, you know, a strong ESG approach when we continue to put fresh financing into fossil fuel generation. Plus, renewables are mostly make more economic sense in many of our countries of operation.
Thank you, Maya. Last thoughts from you, Desiree.
Yeah, I mean, I agree. Listen, you know, as Mark said, I think, you know, that there are two camps, you know, those that, you know, do have, you know, fossil fuel exclusions, divest, and those that are focused on transition. I think that that's up to the investor. You know, divestment does have a very strong signaling aspect to it, you know, but again, if you are, you know, focused on shareholder activism, make sure it's real, right? You know, as, you know, like, make sure it's not just, you know, number of meetings, make sure, you know, you're focused on, you know, a say on climate, you know, you're pushing AGM motions, you're voting in support. And you know, today, you know, I think there is a realization we're not going to divest today. But, you know, I do think with the, you know, the recent reports and statements from the IEA, right, you know, energy security is an immense focus. But in order to stay within the 1.5 degree threshold, we can't afford to start, you know, new projects, right? It's understandable that there might be further CapEx into existing projects in the time being, but that's just, you know, more short term. There's no doubt, as Maya said, that for energy security purposes, we do need to mobilize more money into clean energy and alternatives. And I personally think including nuclear.
Thank you very much. This has been a wonderful panel. Really appreciate it. Thank you.
Thanks, everybody.
Thank you. Thanks for having us.
Thank you. Thank you very much, Tina. Thank you, Maya, Mark, and Desiree, for your very insightful contributions. I think this session was beautiful. I mean, personally, I enjoyed it a lot, but I'm sure the audience enjoyed it a lot as well, because it highlighted the so many open questions and challenges that one needs to undertake in order to walk the ESG path. And actually, your session fit up very well with yesterday's talks, which also highlighted many of the open questions and challenges. So once again, thank you very much for being so honest and transparent.